Hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here. It was an absolutely crazy week in the market, so stick around to the end. A lot to talk about. If you're watching this on YouTube, hit that subscribe button for more content just like it. And here's what we're going to be discussing today. Nikkei, of course, crash there. Number 2, a Monday morning panic in U.S. markets. 3, is Buffett bearish? Talk about the reason people are asking that question. Do we need an emergency Fed rate cut? My view, absolutely not, but some people are arguing for that today. Yield curve is close to turning positive again, so interesting there. I'll tell you what that might mean. Rising credit card delinquencies, really a trend that's been continuing here, and so I'll run through the data. Interesting, in the high yield bond market, we're seeing a little bit of an increase in spreads, but nowhere near pricing in a recession today. Q2 earnings update. I'll give you the latest data there in terms of earnings, and we'll end, as we always do, with something positive. That would be lower gas prices, down 10% over the past year. Okay, let's start out with the Nikkei's 1987 moment, and there was an absolute crash in the Nikkei index. I don't use that word lightly. Here's the data showing you what actually happened on Monday. Second biggest decline in history for the Japanese Nikkei index, down 12.4%, trailed only the 1987 crash when the index declined 14.9%. So did a show that day with Peter Mallouk talking about embracing panic. And so what you want to do when there's panic, when other people are going crazy, losing their minds, is look at the data and look at historically, has it been a good time to be a seller or actually a better time to be a buyer? And historically, what we've seen is actually a better time to be a buyer if you take a longer term view. So what I'm looking at here is what the Nikkei did a year later following the 3 biggest declines that we saw historically. That would be October 1987, 26.5% higher a year later, October 2008, 16.9% higher a year later, and March 2011 following the earthquake and tsunami there, 17.7% higher a year later. So more often than not, panic creates opportunity because you have fear, you have an overreaction in terms of selling, and perhaps that's what we're seeing today. But regardless of what happens in the next year, it's definitely a better time to be a buyer today than a few weeks ago because prices are way, way lower. And it didn't take even a few weeks. If you're just looking at 2 days here, 17.5% lower for this Nikkei index. That's the biggest 2-day decline for the Nikkei in history, more than the 1987 crash. So Nikkei 225, here's a chart that can look absolutely insane because it went from being one of the best performing stock markets in the world, up around 27% in July. And then just a few short weeks later, it's actually down on the year. And if you look at sentiment for Japanese equities, everyone bullish up here in July, everyone bearish down here. You as an investor should be doing the exact opposite. You should be being more bullish right now than a few weeks ago because prices are lower, valuations are lower. It's a better time to be an investor because you actually have a chance to buy in when prices are discounted. So what's the reason for the sell-off? Well, the big reason people are saying is this unwinding of the carry trade, where people are borrowing money from Japan because interest rates there are so low, investing it elsewhere. And they're saying because their Japanese yen rallied so much, there's margin call in terms of this borrowing, and that set off a spiral in terms of selling. And that seems like a good enough reason for a sell-off there because of the move in the Japanese yen was so extreme on a short-term basis. So what we're looking at here on the bottom, you could see that secular kind of decline in the Japanese yen. We've been talking about this, how the Bank of Japan's been pursuing just crazy monetary policy, ultra easy, staying negative for a long, long time, doing massive quantitative easing, way more than what the Fed's done. That's drove the value of the yen down over 50% in the past decade plus. But in the last 20 trading days, reversal, huge reversal. We saw the yen rally over 10% against the dollar in just 20 trading days. That's an extreme move. We haven't seen such a move since October 2008. So back in the financial crisis, we saw a similar rally in the yen as well. And here's the data showing you that increase in cross-border lending. You can see up and to the right, people borrowing more and more, loans to non-bank financial institutions rising. Here, a 21% increase over 2021 levels. You're talking about $1 trillion in this type of lending as of March. And of course, when there's an unwind of that, that's going to have an impact. And if we look at the positioning in terms of yen, of course, speculators were piling on the bearish bets after the yen had already declined significantly. They had 14 billion in net short positions at the end of July. But very quickly, you can see here, this has been cut back 6 billion as of last week. And I suspect when we get an updated data, it'll be much closer to even, maybe even flip in the positive direction. So a lot of people questioning, well, how much of this carry trade unwind, how much is there left to go? And some people say, oh, it's only half over, a quarter over, or 3/4 over. Different people arguing about it, but I would guess that a substantial portion of this is over just by the moves that we've seen in both in terms of the Nikkei and in terms of the yen. But in terms of the US markets, naturally, you would expect this type of move in Japan to have an impact in US markets, and it absolutely did. Had a much bigger impact in terms of volatility than I would have expected. I came in Monday morning looking at the VIX saying, is this correct? Could this actually be real that I'm seeing a VIX at 65 with futures down around 3 to 4%, and just a crazy number, given that equities weren't down 10%, they were down 3 to 4%. So I had to check the data a number of times. It was actually correct, but my guess was this is not going to last unless we see just the market actually collapse from those opening levels on Monday. And we didn't see a collapse. We actually saw the market rally off of those opening levels. And what that did was that caused volatility to collapse into the close. Still closed pretty high here at 38.57 on Monday, but well off the peak from that day. And if you're watching this here and you didn't follow the markets for the entire week, it's pretty incredible. What you would see is the S&P 500 essentially flat on the year, on the week, only down 4 basis points. Just kind of crazy after the week we have that it would actually be flat. So all of the headlines, all of the drama, all of the stuff in terms of the carry trade, and markets actually flat on the week. And look where it was on Monday morning. At one point, it was down over 4%. So pretty significant rally off of those lows. But here's the data in terms of the VIX and what it did on Monday from the peak there above 65 to its close at 38. It actually declined 41%, which was the biggest intraday move off of a high that we've seen in history. 41%, nothing comes even close. And even with that decline, it was still the second biggest one-day spike in the VIX in history, up around 65%. So closed on Friday at 23.39 and it closes on Monday 38.57, second biggest VIX spike in history. I took a look back saying, what has happened in the past following big 3-day VIX spikes? So just last week, the VIX was at 16.36, and 3 trading days later, it's at 38.57. That's a 136% increase. And so what that means is the market has a lot of fear in it today, and last week, obviously not a lot. So what has happened to the S&P 500 looking forward 1 year, 2 year, 3 year, 4 year, 5 years is a good idea, generally speaking, to be a seller or a buyer after this type of panic. Well, you can see here the data on average, much better to be a buyer than a seller, particularly true when you're looking out 5 years, looking out longer term. Market tends to snap back and actually snap back with above average returns. Does that happen all the time? Of course not. There's always exceptions. In February 2007, we had a huge VIX spike over a 3-day period. And then, of course, the market would peak in October 2007, and we'd have that huge 50% decline in the S&P 500. So nothing's 100%, but is it better to be a buyer when there's complacency, or better to be a buyer when there's extreme fear? If you have to pick one of the two, you definitely should be picking extreme fear, because it tends to be associated with a price decline, and it tends to be associated with better levels in terms of valuations. The crazy thing and interesting thing here, of course, is that we got up to that high level of VIX without a big 30-40% decline. S&P was only about 10% off of its peak, and we're looking at a 65 VIX. So here's the data in terms of the week here. You're looking at the fourth consecutive weekly decline for the S&P 500, but just barely, almost finished the week positive. Huge rally from the open on the week on Monday to the close on Friday. The VIX looks even crazier here. You can see the huge spike that we had on Monday morning, and where it ended the week actually down. So actually VIX lower than it was a week ago, even with all this drama. So we'll look back in this week, and you'll have to really dig into the data, because the ending price for the VIX and the S&P 500 don't really tell the story of what went on, obviously, during the week. And there was a pretty broad-based sell-off, and it took down the industry groups that really had been doing the best in terms of technology and semiconductors. Here I'm showing you the semiconductor index, and off of its peak, it was down 23% as of the Monday close. And that was the first close below the 200-day moving average since November 2023. So we've had this huge, enormous run-up in semiconductors. Of course, NVIDIA leading that index higher, and now finally a sizable correction, biggest decline for semiconductors since 2022. And if we look at the S&P 500 as a whole, down 9.7%. We see these types of declines all the time, happens every other year on average, about a 10% intra-year decline, and we're seeing it again today. And people are talking about recession. People are talking about the Fed being behind the curve as being big reasons. Of course, the Nikkei crash, we can add that to the list as well. There's always a reason in hindsight, but this is just yet another pullback off of a high. We've seen this many times since the lows in March 2009. And if we look at sentiment here, I mentioned this last week. What I wanted to see on this correction was the percentage of bulls really come down hard like they did during that April correction. And so far, so good. Big drop in the investors' intelligence percentage. Bulls here went from 64 2 weeks ago. That was the highest level we've seen since 2020, since kind of the mania period at the end of 2020. And in 2 weeks, we're down to 46.9, which is essentially kind of neutral in terms of sentiment. It's certainly not on the bearish end, but that swing, that huge swing from 64 to 46.9 here was the biggest 2-week swing, 17%, biggest 2-week swing that we've seen in this investor intelligence bull since October 1987. So the crash in terms of what happened in the Nikkei, I guess, spilled over in terms of sentiment. And when people were newsletter writers were talking about investments this week, they must have been just much less bullish because of that crash, because of the spike in volatility. And so that's definitely a good sign. Now, if this becomes 15% correction, 20% correction, yeah, this percentage bulls will definitely go lower, but this is absolutely what you want to see with this type of pullback. 10% pullback, and a lot of the bullishness that had been there is now erased, and now we're back to a neutral level of sentiment. So if you're an investor thinking about your portfolio today, what should you be thinking about? What should you be doing? How should you be positioned for the rest of the year and the future? Reach out to us at Creative Planning. We're here to help with all of that stuff. creativeplanning.com/Charlie. You can get a free wealth path analysis right now from us. And that we're going to look through your portfolio. We're going to make sure you're on the right track to retirement. We're going to be looking at tax planning, the strategic tax moves that you can be making. And we'll be looking at your estate planning documents as well, making sure everything's in order. So reach out today to get all 4 of those things. And we're here to help. We're in all 50 states. We likely have a location right near you. So schedule a call or a meeting with us today, creativeplanning.com/Charlie. Number 3 here, this was a big one, and you could add this to the list of perhaps reasons why Monday morning there was such a big sell-off at the open in U.S. markets, and that was what we heard from Berkshire over the weekend. They always announce their earnings outside of market hours, usually on a weekend, and what we saw was them raise a huge amount of cash during the second quarter, and people are interpreting that as Warren Buffett is now bearish on the markets. You can see here the spike in cash, not a small amount of cash raised here, went from 189 billion in terms of cash to 277 billion, biggest 1/4 spike that we've ever seen in terms of the increase in cash. Now, what we have to do here in terms of cash is you can't just look at the absolute number. Obviously, there's a huge spike, but you have to normalize it for the size of Berkshire, which is much bigger today. So on a percentage of assets basis here, you can see it's now about 25% of assets. Not the highest ever, but certainly above average. Average about 14% looking back in history. But this is the highest as a percentage of assets that we've seen from Berkshire since the fourth quarter of 2004. And so what they did in terms of Apple was a big part of that cash raising. Apple, of course, was their biggest position, still is the biggest position, but they sold about 49% of their holdings in Apple during the quarter. And of course, that set off a sell-off in Apple as well on Monday. And similar to the market, Apple would rally back the rest of the week after that. Now, why is Buffett selling Apple, selling stock? Well, there's a big debate. Why are they doing that? He talked a little bit about this in the last meeting that they had, saying that perhaps they're doing it because their belief that taxes are going up. So they have a huge embedded gain, obviously, in Apple, and selling that is going to lead to capital gains. And they're going to be taxed today at 21%. And he's saying not that long ago it was 35%. And because we have this huge fiscal problem where we're just running huge deficits, the debt's going up, he thinks that taxes are likely to go higher in years to come. I think that's probably a decent bet. So that's certainly part of it, but I don't think that's the only reason why Buffett is selling Apple, just to save money for taxes. I think it's also because he's a value investor and the valuations have changed by an enormous amount. If we're looking at Apple, when he was buying this thing, they started to buy it in early 2016. Apple was actually trading at a P just under 10 times earnings. So it was actually, if you looked at the value indices at the time, Apple was one of the biggest holdings in a lot of the value funds that were out there because it was trading at a below market multiple, below 10 times earnings. Its price to sales ratio was about 2 times back then, and its growth rate was pretty high if we look back at Apple at that period of time. Now, if we fast forward to today, very different in terms of valuation. We're talking about a P ratio above 30, and we're talking about a price to sales ratio that I've talked about this year that went above 9 a few weeks ago, which is the highest level in history for Apple. And of course, it's not the big grower that it used to be. It grew revenues over the past year at 5%. In recent years, it's actually seen at some points year-over-year revenue declines. So we're looking at the highest valuation in history in terms of prices to sales when its sales growth has really slowed down. And if we look at the last 10 years, here you can see this is what Buffett would have made on its Apple holdings in the past 10 years. They didn't hold it for the last 10, but almost. They bought it in early 2016. You're looking at a 858% increase in the stock right now over the last 10 years. And if you look at their net income, up 158%, and their revenue up 111%. So clearly, prices running up much more than fundamentals, and that's led to a valuation expansion. And a big part of the returns, of course, in the past decade have been the shareholder buybacks that Apple has done, just returning a huge amount of cash through buybacks in the last 10 years to investors, $646 billion in the last 10 years. And that's bigger than the market cap of 491 companies in the S&P 500. Just an astounding total. They continue to do it. They bought back over $90 billion in stock over the last decade. And I think what Buffett's probably betting on here is saying the next 10 years, it's almost impossible. This is a 10x over the last 10 years. This is a $3 trillion company. How is it going to 10x in the next 10 years? That would be pretty much impossible. It'd be a $30 trillion company 10 years from now. That's obviously not going to happen. And perhaps he's waiting for opportunity elsewhere. So is he bearish on the market? I don't know. But I think valuation obviously has been stretched. We talk about S&P 500 valuation being on the upper end, being elevated, most elevated price to peak earnings since 2000. So certainly that's probably got Buffett's attention. And in order to take advantage of opportunities that might come in the future, if let's say you would have the type of declines that we saw in the Nikkei happen in the US, well, Buffett has to raise cash beforehand in order to take advantage of those opportunities. But just keep in mind a little bit, I think, of overreaction, because Apple still is Berkshire's largest holding. So it's not like they're selling everything. They're not like they're giving up on the company. I think this is more saying we don't want to be as concentrated in something that has this high of a valuation. And if there were to be a big sell-off in Apple shares, I think you could see them, of course, buy it back again in the future. Okay. Number 4, do we really need an emergency rate cut? And this would have been, I think, an absurd question to ask a week ago, but you actually had people arguing for it on Monday when the market was tanking. Jeremy Siegel was on CNBC saying that the Fed needs to do an emergency rate cut, 75 basis points, and they should follow that up with another 75 basis points at the September meeting. And to me, that's just an absolute overreaction to what a 10% decline in the S&P 500. He's saying that the Fed funds rate should be between 3.5% and 4% today, and that the Fed is behind the curve. A lot of people are saying that, and they need to get the job done right now, and they shouldn't wait to that September meeting. To me, that would be a signal of absolute panic from the Fed. The Fed's getting no indication before this. If you look at their July meeting, it was just a week ago, they gave no indication that we needed to have a rate cut here and now. The signaling was for a 25 basis point cut likely in September, but to do something before that meeting, I think would send a message to the market saying that the Fed knows something in terms of the economy that's so bad, and in terms of the financial markets, it's so bad that we need to do this cut. And if we look at the S&P 500 by the end of the week, I suspect that Jeremy Siegel will probably be changing his tune, because it was actually flat in the week. The VIX actually came all the way down. So the market doesn't seem to be saying still that there's any type of an emergency. It was just good old fashioned crash in terms of the Japanese markets. And what I would say in terms of rate cuts in general is this idea that the Fed can all of a sudden save us through a rate cut. They could save us from a recession. They could save us from the stock market going down. Well, that hasn't been the historical precedent. If the market wants to go down, if the market's going to go down, if there's going to be a recession, the Fed has not shown the ability to prevent that through rate cuts. And two primary examples of that would be September 2007, they did a 50 basis point cut back then, and January 2001, 50 basis point cut back then. Those were the first cuts of those cycles. And you can see here what the market returns were a year later, 2 years later, 3 years later, 4 years later. So you had 50% bear markets in both of these cases, despite the Fed being aggressively easy all the way down. So back in 2007, they would continue to cut interest rates all the way to 0% in December 2008. 2001, they brought it down all the way to 1% from 6.5% at the start. And that did not prevent a recession in 2001, did not prevent a recession in 2008, 2009. Worst recession, by the way, since the Great Depression. The Fed couldn't stop it. So this idea that if they just magically go out and cut 75 basis points tomorrow, that there'll never be a recession again, I think obviously looking at the historical data, that's false. The Fed needs to be prudent in terms of interest rate policy. They can't be sending a message that's being so reactive to financial markets. And to their credit, they didn't do that in 2022. So a lot of people back then, if you look at the headlines, just Google it, people calling for the Fed to cut interest rates in 2022 because the S&P 500 was in a bear market and was going down, and people saying, doesn't the Fed see the markets are going down? They need to cut interest rates now. The Fed didn't listen because inflation was still a problem, and hopefully they're not listening to these people today. Inflation, in my view, is still the bigger concern, the bigger problem, and there shouldn't be a huge rush to bring interest rates back down. Now, which one of these, when the Fed does cut in September, and it seems pretty likely they're going to, which one of these examples is this going to be? Well, that depends, I think, entirely, of course, on whether the economy goes into a recession. So be careful what you wish for. If you want to see the Fed cut rates back down to zero, then you're essentially saying it's going to be a deep recession coming in the next year. We absolutely don't want to see that, of course. So hopefully that's not what happens. In terms of the recession, I put out this poll this week, got 7,000 people voted asking about the US economy. I said, isn't it a recession today? Will it be in a recession in the next 6 months? So about to enter a recession, or none of those two, the expansion continues for at least another 6 months. Here's the breakdown. We had 29% people say we're already in a recession today, 32% say we're about to enter a recession, and 38% say the expansion continues. So more than half saying we're either in a recession or about to enter recession, but still a decent percentage of people saying no, expansion continues. It's hard, I think it would be hard to argue that we're in a recession here and now. So right here today. Of course, we won't get the data for the third quarter GDP until a few months from now. But to say that we're already in a recession today, you'd have to believe that economic activity is already contracting. That doesn't seem to be the case looking at the data. Doesn't mean we can't be in as soon as the fourth quarter, but here and now, I would say it's hard to believe that that would be the case. Looking at the Atlanta Fed, they do this GDP now estimate, taking different components, data points, and their estimate is still a little bit below 3%. Now, this can change as we get more data. Look at Wall Street. They're certainly not expecting a recession. Not that they do a good job. We're predicting this a little under 2%, but just given the amount of fiscal stimulus that's going on, given the fact that the unemployment rate, yes, it's up, but it's still relatively low, below the historical average. If we look at wage growth in the past year, still above the rate of inflation, I think it would be hard to argue that here and now, well, we are already in a recession. And so why do I think the Fed should absolutely not do an emergency rate cut here and be very careful in the speed in which they cut interest rates? It's because we haven't erased the above average inflation in recent years. So just because inflation's moving closer to 2%, we're still at 3% in the last year, and we still have 11% inflation above that 2% trend line. So my preference would be wait till this gets back to the trend line before you cut interest rates at all. I don't think that's going to happen. The Fed clearly wants to pursue its easy money policy, and they want to move back down in terms of the Fed funds rate. But this idea that we need an emergency cut and that would be better long term for the economy, I absolutely disagree. I think we have to take away this extra inflation, and that would benefit more people than going back to pursuing an easy money policy. Okay, why is the yield curve close to turning positive again? Well, let's first talk about where it's coming from. This is by far the longest inversion in terms of the yield curve in history. You can see 10-year, I'm looking at the 10-year and the 2-year, 758 days from the first inversion here, consecutive days, July 2022. So now we're over 2 years in terms of this being inverted, but we're getting closer every single day to it flipping to positive. So basically this means the shorter term yield, the 2-year treasury yield, has been above the 10-year yield for over 2 years now, but we're getting closer to the point where the 2-year gets back below the 10-year, which is more normal. So you'd expect in a normal upward sloping yield curve to receive a higher yield for the longer maturity. And because you're locking it up for longer, you would expect that higher yield. There's also more risk in that security in terms of the duration. But if we're looking at here how we're narrowing that spread here, it's what's called a bull steepener. So we're steepening here with the short-term yield, the 2-year treasury rate, moving down faster than the 10-year treasury rate. And when that tends to happen, it tends to happen when the market starts pricing in aggressive Fed rate cuts. So that seems to be the market's expectation here. That's why the yield curve is uninverting with the 10 and the 2-year. The 3-month that I also look at won't get closer to uninverting until the Fed actually begins to cut interest rates, because that's more tied to the Fed's actual action here. But the 2-year yield moving lower is forecasting lower Fed funds rate to come. And you can see here, this is the curve in terms of the expectations. The market's saying right now, this is on Friday, this could change, of course, 50 basis points in September, 25 in November, 25 in December, 25 January, 25 in March. So what the market's essentially saying is by the end of the year, we're going to be about 100 basis points lower in terms of the Fed funds rate. And then in 2025, we're going to do another 100 basis points. And if the Fed actually does that, you're likely to see the yield curve here uninvert in the next few weeks, probably approaching that September meeting in terms of 10s and 2s. Now, here's the interesting thing about the yield curve uninverting. A lot of people talking about the inverted yield curve as a recession signal, but it's not until the yield curve actually turns positive again that you tend to see the recession actually begin. So here turning positive again would be actually getting closer to the point where there might be economic weakness. So will be interesting to see if this time is different. But in the past, when you've had long periods of inversion and then you have moving back to a positive slope, at some point, not too much longer after it turns positive, do you have the recession begin. So we'll see if that's an actual indicator of something or it ends up being all noise. A lot of people have been dismissive about the yield curve in terms of a recession signal, but what they're forgetting is it's a long leading indicator. And what I've said in the past is on average, it's taken 2 years from the first inversion for the recession to begin. So we're not just now at 2 years for the 10-year versus 2-year. We're just now at the 2-year mark. So if we were to see a recession, let's say by the end of the year it starts, well, that would be well within the historical range in terms of predictive power. So don't count out the yield curve just yet in terms of the predictive power, in terms of predicting a recession. But I don't believe here and now, looking in August 2024, it doesn't seem to be, if you put all the data together, it doesn't seem to be that the economy is yet in a recession. Now, what could push it into a recession? Well, it almost always is a slowdown in terms of the U.S. consumer. We've been talking about consumer weakness for months now, but it hasn't risen yet enough to the point where it's pushing the economy into a recession. But here's another data point moving in the wrong direction. That would be rising credit card delinquencies. So we have 1.14 trillion now in terms of credit card debt in the US. That hit another record high in the second quarter, up 10%, 10.8% over the past year. So still running pretty hot in terms of increasing credit card debt in the US. And a big reason for that is, of course, that people are feeling strapped, especially lower income Americans, and their wages really have struggled to increase, but struggled to increase as much as the rate of inflation. And so people are kind of borrowing to close that gap. And this is a big contrast with overall consumer credit. You can see here is actually up only 1.8% in the past year, slowing significantly, which is very interesting as well, because you can see when it went negative in 2020, went negative in 08, 09 period, that was, of course, a signal of a recession, also early 1990s as well. So perhaps credit contraction here is yet another indicator predicting weakness. But in terms of credit cards, what's the big problem? Well, interest rates are at a record high, over 20% in terms of interest rates. And what we're seeing here is rising delinquencies. This is a percentage of credit card balances over 90 days delinquent. You can see up to close to 11% of balances now. That's the highest we've seen since 2012. You can see auto loans obviously trending higher as well, but these other areas in terms of mortgages, student loans, which of course had that big period where you didn't have to make any payments and didn't accrue interest, and home equity, not seeing any uptick at all. So this is the big portion of the credit market, this and auto loans, that people are focusing on, higher delinquencies. And what we're seeing is not just a contraction in terms of consumer credit, we're also seeing this personal savings rate go down as well. So what we're seeing, I think, is that consumer is getting closer to being tapped out. This is a very different consumer that we saw in 2020 in 2021 after the stimulus, where they were just spending like mad. Retail sales exploded higher. Very different, more discerning consumer today than back then. And given that the U.S. economy is over 70% comes from the U.S. consumer, if we see a pullback in meaningful pullback in terms of consumer spending, obviously that would be the thing that tips the economy into recession. The question is, will that happen before we see real job losses, before we see wages really start to go flat on a year-over-year basis? That's the big question, because for now, although they're not spending money on the retail sector, they still seem to be spending on things like travel. So keep a close eye on all of that in terms of the U.S. consumer, especially with this credit card data. But with the Fed set to cut interest rates, bring them down, that should help some of these people with credit card balances. That's the good side of interest rate cuts. So high yield bonds, historically pretty good signaler in terms of a recession. And today, the interesting thing is they're not even close to signaling a recession. A lot of people talking about that recession, but in terms of the default risk priced into the high yield bond market, it simply isn't there. This was the spike after Monday's session that we saw in the high yield market. You can see here just a little blip here, went from 302 basis points, which is almost the lowest that we've seen since 2007, to 393 basis points. That's absolutely nothing in terms of historically, even big corrections we've seen in the past. We've seen higher spreads than 393 basis points. And for the remainder of the week, what did high yield bonds do? Well, they rallied significantly and spreads tightened once again. And so if this is going to signal a recession, we'd expect to see much higher high yield spreads. I'm showing you a table here of the biggest S&P 500 corrections since 1996 and what the high yield bond spread has done. And you can see here, if it's a recession, the high yield bond spread's likely to get over 1,000 basis points. So this is a spread between high yield bond yields and treasury yields of a similar duration that are risk-free. And of course, we're nowhere near that today. And in 2022, this is what we were talking about when it hit 599 basis points. Why isn't it much higher if we're going into a recession, if we're in a recession? Ended up being not a signal, of course, of a recession. And it was actually a good indicator because in hindsight, it didn't show that huge spike in default risk, and it was actually correct. So a lot of complacency a few weeks ago in the credit markets, less complacency today, but keep an eye on high yield spreads. They're likely to blow out much wider if this is going to turn into an economic downturn. All right, quickly, U.S. earnings update. Data, again, not terrible, not great, somewhere in between 5.5% increase in revenues per share over the past year, with 82% of companies reporting. We have EPS growth ticking up. So last week we were looking at 3% year-over-year growth, actually now 7% year-over-year growth. So better numbers coming in. And we have 82% companies reported. So we still have more reports to come. Of course, NVIDIA is going to be the big one that everyone is going to talk about and obviously send a signal for that tech sector. If we look at operating earnings, you can see here another record high in terms of trailing 12-month operating earnings. So the fundamentally market and the earnings long term are tied very much together. In the short term, they can deviate, and they deviate because of sentiment. And what we were talking about entering earnings season is you had prices going up well over 20% in the past year, when earnings, we're looking at trailing 12-month earnings, were up around 5%. So they had that huge gap, multiple expansion. Now we've had a correction. But the question for Q3 and Q4 is, are earnings going to explode higher? That's what the market seems to be pricing in here. The market's certainly expecting great earnings in Q3 and Q4. What could change that? Obviously, a recession would be a big one to change that. But if we don't see that, that's a sign of disappointment. If we do, then perhaps those huge price gains were actually justified. So lastly here, talking about margins actually expanding this quarter, which you definitely don't tend to see during a recession here. 12% in terms of margins for the S&P 500. That was the highest operating profit margin that we've seen since the fourth quarter of 2021. And if we look at the big four here, trailing 12-month revenues, they just continue to go up collectively. Amazon, Apple, Google, and Microsoft hitting another record in terms of their combined revenue. Their revenues are bigger than all but 15 countries in terms of the GDP of those countries. So just absolutely insane, the growth of these four companies over the last decade. And I don't think the next decade will see similar growth rates, but they've just gotten to be tremendous companies. Amazon now getting closer and closer to Walmart in terms of being the number one company for sales in the US. So when I end, as I always do, it's something positive. That would be lower gas prices, $3.45 a gallon in the US. It's down 10% from year ago levels. And this is going to be one of the factors that's likely to drive August CPI lower. We're not going to get that number until September, but it's going to come out a week before the FOMC meeting. And what we're seeing here is the Cleveland Fed's expectation, 2.7% they're expecting for August CPI. That would be the best number we've seen in a few years. And I think that would solidify the Fed's rate cut in September. And good news to see prices coming down. We talked about used cars continuing to trend lower, gas prices continue to trend lower, food prices continue to trend lower. So all good signs there. Rents trending lower, and slowly but surely things are becoming more affordable. And my preference, of course, would be to continue to let prices normalize before you start normalizing interest rates. But this is definitely enough, in my view, for the Fed to say we're going to start 25 basis points or 50 basis points in September. Okay, with that, I'll end it there. Thanks everyone for joining me. If you're watching this on YouTube, hit that subscribe button for more content. Have an awesome weekend, and I'll see you next time on the Week in Charts.